Hey friends, I'm back with another video about dividend stock investing. In the video today, I want to cover two core dividend stocks. I believe both are compelling values right now. In fact, I'm going to be purchasing one of them this week. I just did a video recently about 6 core dividend stocks that I'm purchasing right now, and I'm going to link to that in the pinned comment below. When I did that video recently, some subscribers reached out and said, Ian, there are 2 stocks that you had missed in your analysis. Please cover them. And I actually looked at those 2 stocks, and you know what? The community was right. And so there are 2 more core stocks I want to add to the list. One of them, by the way, is Coca-Cola. This is the one I want to purchase this week. I'm excited about this stock because I have not purchased it for a while. It has a compelling starting dividend yield, and so I'm going to buy some more this week because I set the rule for myself a while ago that all of my core stocks, I want to try to purchase at least a few times per year. And of course, at least once per year, all of those core stocks that I own, because the core stocks are my priority. The other stock I'm going to highlight in the video today is Procter Gamble. They make Bounce, by the way, these dryer sheets, and so many other products. Finally, Procter Gamble has corrected in share price, and it looks to be on sale again. And so this is a stock I want to cover as well. I probably won't purchase Procter Gamble this week, but I'll look forward to purchasing some more soon. It's interesting, there's a backdrop right now that dividend stocks are doing really well. We're in a tumultuous economy right now. Inflation is out of control. There's starting to be some news out there about layoffs. It's really scary, but dividend stocks, they just keep marching forward. Just recently, PepsiCo shared their earnings release. I'm going to share that on the screen right now, by the way. We need to take a moment and just look at this. It is just fabulous that net revenue growth in the third quarter, comparing the third quarter to the third quarter last year, it's up 8.8%. And we see that the earnings per share here are up 22% year over year. And so PepsiCo, because of these fabulous results, the stock started going up quite a bit. And right now it's only down about 5% from its 52-week high. And so this stock has weathered the storm really well. During good times, during bull markets, sometimes people will look at dividend stock investors and they'll say, hey, why are you doing this? It's so boring. It's not really fun like all of those tech stocks. But dividend investors who have been through many cycles start to realize that it's not only about those good times, those exciting times when the tech stocks are hockey sticking up and to the right, but it's also about long term and looking at all types of markets, including bear markets like we're in right now. And the dividend stocks are performing so well right now, not only with financial results, but also with predictable cash flow. And with that, I want to share on the screen right now. I did a tweet, by the way. Follow me on Twitter. I will link to that in the pinned comment below. But what's so fun about this tweet is I share about McDonald's. They just increased the dividend, by the way, by 10% because their business is doing so well. Our economy right now is rocky. Financial markets are rocky. Inflation is really tough right now. But McDonald's increased the dividend by 10%. Well, it just so happens I bought my first tranche of McDonald's back in 2011 at $73.53. Now, I'm not even looking at reinvested dividends for this analysis, but if I just look at a simple yield on cost, which is the current annualized dividends based on the new rate after they increase the dividend, I take that $6.08, I divide by my initial purchase price. I'm getting 8.27% simple yield on cost on my first tranche of McDonald's. And so it's so exciting that during this backdrop of really difficult times, dividend stocks like PepsiCo and McDonald's are weathering the storm. And I did cover those 2, by the way, in that video that I will link to in the pinned comment. Those 2 were part of my initial 6, and I'm going to append that list in the video today with 2 more, which are Coca-Cola and Procter Gamble, and I'm going to do a really fun comparison against Treasury Bonds, which quite frankly are compelling right now as well. In my humble opinion, get ready everyone for a really exciting dividend investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So it's kind of late at night. It's 9:30 on a Monday. It's already been a really busy Monday. So I would greatly appreciate if you enjoy these videos, if you enjoy the effort that I put into each and every video, please go ahead and click that like button. It really helps me out here on YouTube. It helps the video get more traction. It means the world to me. Also, don't forget to subscribe because I do have new videos on the way all the time. And by the way, before I go into the video today, do check out the pinned comment below as well. I will link into my Patreon. I had a really fun Corner Patreon virtual meetup on Zoom last week. Shout out to all my friends that made it. We had a really good attendance at that virtual meetup. And check out Patreon. I have a lot of perks and bonuses over there. I have a link to it in the pinned comment below. And so I want to share a bit of an agenda on the screen right now. As you can see in front of you, this is the agenda for today. I already went through item number 1, which is that core dividend stocks have performed very well in light of an overall wacky stock market right now. And so, honestly speaking, most core dividend stocks right now, they're not really on sale. Look at PepsiCo. It's down only 4.8% from its 52-week high, although I did buy more today. It was a strategic move because I'm trying to increase the weighting of that position. It's my number 3 position, but it's a distant number 3 behind my number 1 and 2, and so it was strategic. I'm always averaging into it. But some dividend stocks right now, they are trading off of their highs. And the two I'm going to cover today, quite frankly, they're off their 52-week highs. And so there is some compelling value there. I'm not going to say Coca-Cola and Procter Gamble are deep value right now, but they're interesting values. I'm going to talk about inflation today. I want to talk about Treasury Bonds and how because inflation is strong, because interest rates are surging, because bond values are tanking and consequently interest rates are going up, there's really some interesting opportunities out there with treasuries. I want to actually compare treasury yields, which are now in the 4+% range, not only on the long bonds, but on the shorter end of the yield curve as well. It's really interesting to see the shorter duration bills and notes right now with really high interest rates. I want to do some models and compare those rates to dividend investing in a company like Procter Gamble. I actually plan to participate in the Treasury Auction this week. I want to go through that. And honestly, I'm going to conclude with a thought just about the stock market. Basically, we live in a terrible world now, honestly, where a market crash always seems imminent, and that is why I structure my portfolio the way I structure it. And so that's just something to keep in mind. People ask why I'm looking at bonds more frequently right now. Well, one, I see compelling value with bonds, but 2, I structure my portfolio to minimize volatility. Given the landscape right now that our world is changing so quickly and there's more risk than I've ever seen before, but I have to keep marching forward with my goals of passive income and cash flow. And so with that, I want to share on the screen right now, real quick, this is just a highlight of my PepsiCo trade today, just so you can see. This is an example of a core dividend stock that is only 4.8% off its 52-week high. That's because of the earnings release that is so strong. It is not really a compelling value. I would say it's trading at a fair value, given the quality of the company and given the non-quality, I guess, of our overall economy. Everyone wants to own quality, especially when times are rocky. And that's why so many people right now who are traditional growth investors, they may be taking a look at dividend investing right now. Anyway, it was fun. My friend Sam, who's a dividend investor, shout out Sam. He put a fun tweet over there on Twitter the other day that said something to the effect that he became a dividend investor during a market crash. And honestly, during the recent market crash, I bet you, or he believes, and I believe as well, that there's probably going to be some new dividend investors. So welcome to all the new dividend investors out there. But check it out in front of you right now. PepsiCo right now on a forward PE is trading trading at a 25 this year, 23 next year. Not really that cheap, but I'm adding to it. Starting yield is 2.7%. Payout ratio is 68%. I always thought the payout ratio was a little high, but honestly, their earnings are growing so quickly that it's staying somewhat manageable. And I love their 5-year dividend growth rate of 7.4%. That is just fantastic, absolutely fantastic dividend growth. And so with that, I want to share with all of you the 2 additional dividend stocks today that I think are compelling values right now, reasonable values for core stocks. I am going to be buying some Coca-Cola this week. And so I just shared PepsiCo. So let's take a look at their competitor Coca-Cola. As you can see on the screen in front of you right now, on Coca-Cola, it's actually 17% off of its 52-week high. So it's trading at 55.69. It's not down that much, but hey, 17%, that's a good drop for a world-class name like Coca-Cola. And based on their forward earnings estimates, it's trading at a PE this year of a 22, next year 21. So you can see it's a little bit cheaper than PepsiCo. And what I like about Coca-Cola is the starting yield. I highlight it here because it's 3.2%. The investor with Coca-Cola does not get really quick dividend growth. In fact, it's only growing on average by 3.5% per year. But the starting yield is pretty good at 3.2%. Market cap $240 billion. As I look at a stock like Coca-Cola, what goes through my mind, and I imagine this has to be going through your mind at home, is, hey, Treasury bond rates right now. My favorite Treasury, by the way, is the 20-year. I think it's like a perfect duration for me, at least, because I'm in my 40s. By the time I'm in my 60s, the bond will be maturing. And so all these years, I'll collect some passive income that I can use either to reinvest or pay bills. And by the time I might need a stopgap measure or some extra change, is going to come in those retirement years in the 60s. And so it's a perfect timed bond for me right now. But as you can see on the screen right now, check it out. This is helpful. It actually is from the CNBC website. They have really helpful information. The 20-year Treasury right now is trading at a 4.299, basically 4.3% yield. And so when I see something like Coca-Cola that's starting yield is 3.2%, it's less than that of the Treasury. And obviously a company like Coca-Cola contains some level of a risk, although it's a core dividend stock, so it's going to have a little less risk than your average company out there, probably in the S&P 500. It's a very stable company, but it does not have the level of risk of a Treasury bond. Treasury bonds in general, I look at as somewhat risk-free. I mean, I guess there's always the risk that the U.S. government could default on their bonds, but I believe that's a fairly low risk. I think the other risk is that inflation could be just so terrible that the value of the bond erodes. But honestly, if inflation gets to that point where it's just like totally out of control, it will affect companies like PepsiCo and Coca-Cola as well. They have pricing power right now, but they won't have pricing power in the case of just a hyper inflation. And so anyway, though, I look at something like Coca-Cola and I juxtapose it with the Treasury bonds, and I start seeing some trade-offs for myself as an investor. And so I'm going to cover some of those trade-offs in the video today, specifically from a performance basis, but I wanted to kind of plant the seed right now so you can start thinking about that at home as I go through the video. But before I get to that, I do want to go to Procter & Gamble. So as you can see on the screen right now, I talked about Procter & Gamble quite a bit. I think it was back in 2018. Around that time, I was buying Procter & Gamble like crazy. I built a good position. And now it's starting to come down again. It's 23% off its 52-week high. And so whenever that happens with a core dividend stock, dividend investors take notice. And it's trading at a forward PE of 21 this year, 20 next year. It's not really a deep value. I would call this stock a deep value if the forward PE were somewhere between a 15 and a 17. But honestly, being at these levels, it's a fair price, if not somewhat of a compelling value, given the backdrop just that what else is there to invest in this world right now where so many companies are struggling, and companies like McDonald's, PepsiCo, Coca-Cola, Procter Gamble, they really are not. And this is where dividend stocks highlight and shine so well. They're doing well in this economy. They're increasing the dividends. Their earnings are great. And so anyway, the starting yield at Procter Gamble is almost 3% now. It's at 2.9. And so I highlight that because that's exciting. That's a somewhat compelling starting yield. It's not as good as it was back in 2018, but still, it's not a bad starting yield for Procter Gamble. Payout ratio 62%. What I like about Procter & Gamble, I guess, as compared to Coca-Cola, is at least it has some dividend growth. It's below my target of 7%, but it is at 5.78%, which honestly is, it's not too bad. And so, again, Procter & Gamble, Coca-Cola, I look at these kind of stocks, and honestly, the 6 stocks I discussed in the recent video, but I start looking at as compared to the Treasury. And again, as you look at the Treasury on the screen right now, the key thing I want to point out here is Treasuries are surging now to new heights in terms of yields. Obviously, the underlying value of those Treasuries is going down over time. Value goes down, yields go up. But the key thing that worth remembering here, I buy Treasuries directly from the U.S. government, and if I hold them through maturity, I will get the amount I invested back. Plus, obviously, I get interest paid to me semi-annually. And worth noting on the whole topic of Treasuries, when I get interest from Treasuries, I really could spend it. I don't mind spending it. It's something I can use in the short run to enjoy some passive income. And look, I use some of my dividends too from time to time to spend them to pay for living expenses. More often than not, though, I have a hard time spending dividends just yet. I'd rather reinvest them given where I'm at in my investing career, given that I have a long time horizon. And so one way I look at Treasuries, just in addition to adding a little less risk to the portfolio, to dampening some of the volatility, even though the portfolio already is low volatility, as we can see in the video today through how well these dividend stocks are performing. I look at Treasuries, though, just as another means of cash flow, and cash flow that honestly I don't really mind spending so much, as it kind of pains me to spend dividend cash flow. And I'm getting a little better at spending dividend cash flow, but honestly, sometimes I'm not. These days, I just am reinvesting so much of it because I see compelling values. But anyway, as you can see on the screen right now, later this week, I think it's on, not tomorrow, but on Wednesday, there is going to be a offering. This is a reopening of the 20-year Treasury. It's actually going to be a 19-year and 10-month, I guess. This is a 3 3/8% bond, but it's going to be priced, in my opinion, similar to the yields we're seeing. I think it will end up in auction being priced somewhere around probably 4.2, 4.3%. And so I'm going to be participating in that auction because I want to add yet another 20-year Treasury bond to my bond portfolio. And I do share my bond portfolio over on Corner Patreon, by the way. And so anyway, though, bonds worth noting are a smaller percentage of the portfolio. Obviously, my portfolio is very heavily weighted in core dividend stocks. But I want to do an analysis because some investors may be thinking, and I thought the same, Ian, should you really be buying stocks like Procter & Gamble or Coca-Cola when you can just be putting the same money in Treasuries at this point because they have a higher starting yield? Well, first worth mentioning, Treasury bonds and core dividend stocks have different tax consequences. And so I do tend to discount the Treasury yields just a little bit when I'm comparing to core dividend stocks because Treasury yields are generally taxed as ordinary income. Now, thankfully, they're generally exempt from state and local taxes, but they are taxed at a federal level, and they generally fall into the bucket of ordinary income, whereas dividends is qualified dividend income. It's typically taxed as long-term capital gains, at least Coca-Cola and Procter & Gamble. But with that, I want to share a model on the screen right now. As you can see in front of you right now, this is a simple yield on cost model that looks at Procter & Gamble over time. The reason I'm looking at this model is I want to understand where the inflection point happens with current Treasury yields. This is a model that stipulates that each year I'm just taking the passive income from Procter & Gamble and I'm spending it. I'm not reinvesting it. I'm going to share another model next which shares reinvestment. So the first year we know the share price is what it is now, which is $127.34. And so the current dividend yield, starting dividend yield is 2.87%. And so we just know year one, it's real easy. It's the metrics I already shared earlier in the video. But year two, what I'm assuming is, well, the share price goes up a little. I'm assuming for this model, on average, over time, the share price grows by 7% per year. And I think that's pretty realistic for Procter & Gamble into the future. I'm also assuming 5.78% dividend growth on average per year, which I again think is pretty representative for Procter & Gamble and dividend stock investing in low volatility core stocks in general. You can see in year two, stock price went up a bit. That's because it went up by 7%. You can see the current dividend yield. It's actually a little lower than the first year, but that's because the stock price is growing a little quicker than the dividend yield. But you can see raw cash flow is higher. The reason raw cash flow is higher is we know the dividend is actually up. First year it was $365, but we know in the second year it's gone up to $386 because it grew by 5.78%. And so in the second year, you can see the dividend cash flow, it's higher. It's $30.35 instead of $28.69 in the first year. We can also look at a simple yield on cost, which is the last column. And all that does is it takes the cash flow that's coming through and divides by the amount invested. And so I take $30.35 and I divide by $1,000 hypothetically invested, I get 3%. Anyway, I keep doing this exercise year in and year out. One of the fun things worth noting is after 20 years, the simple yield on cost is 8%. And what's funny is I did that with McDonald's. I got a comparable yield on cost there just after about 11 years. But anyway, in this particular model, it's going to take 20 years to get to that 8.34% simple yield on cost. But we're not here to look at that. That's just kind of looking why dividends are so amazing. I want to know where the inflection is with Treasury yields on a simple yield on cost. And keep in mind, I'm not reinvesting dividends in this model. Now, it would really happen, I would say, between years 6 and 8. The reason I highlight those 3 years is I'm not doing a tax analysis in this particular video. But again, I know that dividends in general are more tax-friendly than Treasury yields, although Treasuries do have the benefit, again, of not being taxed, generally speaking, here in the U.S. on state and local levels. But again, the dividend stocks are a little bit more tax efficient in general, and so that's why I highlight years 6, 7, and 8. Certainly by year 8 in the simple yield on cost model, I'm hitting an inflection point where the dividend stock is offering a higher yield on cost, or at least a comparable yield on cost to Treasuries. Now, why it's important to look at something like this is, for me, it helps me understand, Ian, is my dividend stock investing time horizon where I really want to tap into cash flow 6 years, 8 years, or a lot more? For me at this point in my life, because I love what I'm doing and I have a big passion for my work, I work in real estate, commercial real estate, I don't plan to retire anytime soon. That being said, I do want to have more flexibility in life. I do want to take more vacations. I do want to enjoy life more. But when I look at everything, realistically, do I have an investing time horizon more than 8 years? Absolutely, I do. My investing time horizon, quite frankly, I'm looking into the multi-decades. And I'm also looking forever because I'm trying to build a portfolio that lives on for generations. But there are investors who watch this channel who literally want to retire tomorrow, or they want to retire in 2 years from now, 3 years from now. And investors sometimes are trying to make trade-offs. Does it make sense to go into Treasuries or a stock like Procter & Gamble? Well, Treasuries right now may be more advantageous potentially for investors who want to retire right away, as the model shows. But that's not the only model I want to look at with dividend reinvestment. So check it out on the screen right now. The second model that you can see in front of you is the same as the first model, but the main difference is I am reinvesting dividends each year. And so what you can see in this model, quite frankly, is share count goes up over time. There's a starting shares, there's new shares, there's ending shares. I don't want to go through this model in too much painstaking detail, but what is happening in this model is there are more shares being purchased from dividends. Because this is reinvesting the capital, the yield on cost, the true yield on cost, grows quicker. Now, to be fair, I'm not doing the same model with Treasuries. I could do the same thing with Treasuries potentially and take the Treasury yields, instead of spending it, reinvest and buy more tranches of Treasuries. But I'm just trying to keep it simple here and assume I'm not doing that with the Treasuries, but I'm just kind of comparing it I would say kind of back of envelope analysis to dividends. Long story short, because I'm reinvesting dividends in the second model, it escalates the years where that inflection point happens, and now it's happening between years 4, 5, and 6, somewhere in that range, depending on tax consequences for the individual investor. Really, the overlap between these two models happens around year 6, and so the way I kind of compare it at this point, if I'm looking at treasuries and I'm comparing it to dividend stock investing, I would say for a core dividend stock like Procter Gamble, it's really looking around year 6 at this point where that inflection point happens. And so for investors who want to tap into money before year 6 and just start living off of cash flow right now and using it all up, maybe treasuries could have a bigger place in a portfolio. But for investors who have a lot more time on their hands, like 6 years or more, preferably in the decades, we all know what happens with dividend stock investing. And as you can see on the screen in front of you, after 20 years with full dividend reinvestment based on the model that I have here, the second model, there's a 13.6% yield on cost, true yield on cost, all the way in the model on the bottom right. That could theoretically be possible with Procter & Gamble. Now, worth noting again, I'm just taking the past numbers and assuming in general that they can happen in the future. But what I do want to point out for everyone is, quite frankly, we live in a world right now that is different than any world I have ever lived in. The investing climate is not like when I started investing in McDonald's. I shared a tweet earlier in the video. I'll put it on the screen again. I'm doing phenomenally well in McDonald's. But when I was buying McDonald's back in 2011, the world was not like it is now. And so we all know going forward, 2022 and forward, it's not like investing in 2011. And so I realize that, I recognize that the models could break down. It could be that there's so much more risk buying something like Procter & Gamble that it skews even more in favor of treasuries. I don't know. But for me, why am I structuring my portfolio right now in 2022 with a component of treasuries? I'm doing it for that reason, because I don't know what's around the corner. I want to dampen the portfolio volatility. It yields over 4%. Honestly, I can start using some of that cash flow right now to enjoy some luxury travel around the world, which I really want to do with my family. And so for me, that's why I'm structuring the portfolio the way I am. But of course, I'm just speaking to my personal situation in the video today. Hey everyone, I hope you enjoyed the video. It's late at night. I actually had to pause and start a few times with this video. I'm going to have a little extra editing. I'm tired here. I haven't had my coffee since early this morning. But if you enjoyed the video, if you click that like button, it really does mean the world to me, with that notification bell as well. I actually subscribe with that notification bell as well. That means the world also. Before I go today, in terms of a full disclosure, I do own the stocks mentioned today. I'm long Coca-Cola, ticker KO, Procter & Gamble, ticker PG. I'm long Treasury Bonds. I'm long PepsiCo, ticker PEP, and McDonald's, MCD. I own those stocks and that bond in my personal portfolio. Today's video, by the way, in terms of a friendly disclaimer, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my personal journey here on YouTube for fun and entertainment. It's possible to lose money in stocks and in bonds as well. We know right now in 2022 that the bond market is absolutely tanking like none other, and that's why the starting yields on treasuries are so good right now. There's a lot of volatility out there, a lot of risk. It's possible to lose a lot of money. And so it's important, if you're going to go out and invest in the stock market, bond market, or anywhere else, to please consult a licensed financial advisor first. I'm just sharing my personal journey here, my personal thought process, my personal conclusions on YouTube for fun and entertainment. But as we know, these are uncharted waters ahead. And so thank you everyone for watching. I will see you in the comments below, and I hope you all have a wonderful week.